Fiscal policies, which include taxation and government spending, are changed by the government in order to achieve the economic objectives of the government. Fiscal policy is also called supply-side policy, because it aims to influence aggregate demand. Fiscal policies are divided into two groups: reflationary, which aim to increase aggregate demand, and deflationary, which are designed to lower aggregate demand. The government is trying to make aggregate demand equal to aggregate supply in order to achieve economic stability, which includes low inflation and low unemployment. It can be used also for encouraging consumption of merit goods and decreasing consumption of goods with bad externalities. There are two types of policies. Firstly, automatic stabilizers is an automatic change in taxation and government spending when there is change in the economic activity. An example is, higher GDP will mean more taxes are collected, although the tax rates stay unchanged. There is also discretionary fiscal policy, when the government changes its spending or taxation in order to influence aggregate demand. Types of taxes. Progressive tax is a tax which takes bigger percentage from the income of the rich, like income tax. Regressive tax is a tax which takes bigger percentage from the income of the poor, usually indirect taxes like VAT, which is paid for almost every product you buy in the shop. Direct tax, tax on your income or profits, which cannot be avoided. Indirect tax, tax on goods and services, is an example like VAT and can be avoided. Excise duty tax, indirect tax on specific products such as tobacco, alcohol and petrol. Capital gains is a tax on the increase in price of certain products like shares, second homes, and is the difference between actual value and the price. Corporation tax is a tax on the profits of a firm. Inheritance tax is a tax on transfers of wealth above certain amount. Types of government spending. Capital expenditure, spending on roads, hospitals, schools and etc. Current spending, spending on the management of public services such as teachers' pay and purchase of medicines. Transfer payments is paying benefits for pensioners, unemployed and etc. Debt interest payments is paying to holders of debt, which is paying interest rates to owners of bonds. This payment is affected by the level of government debt and rate of interests. The four highest spending areas are in UK for 2010 to 2011 are the Department for Work and Pensioners on benefits for unemployed and pensions. Department of Health, around £87.6 billion on NHS. Education, revenue and customs such as child benefits. The budget, it is a review of government spending and taxation, and any changes are announced each year in the budget. It shows future predictions about government spending and taxation while showing also the last year rates. A budget deficit is when the government spending is more than taxes. A budget surplus is when the opposite of government deficit, and it allows the government to pay its debt or increase spending in the future.